Hello and welcome to EduFund. Today we have a very special guest with us, Shelly Gang from Tata Asset Management. Shelly joined Tata in February 2019 and she has 18 years of experience. She has previously worked with ICICI Bank and Royal Bank of Scotland. She started her career with HDFC Bank and has a vast experience in banking and wealth management. Qualification-wise, Shelly holds a BCom from Mulund College of Commerce in Mumbai and an MBA in Finance from Chetana's Institute of Management and Research. In today's episode, we are going to talk about Tata Nifty Realty Index Fund, which Tata is going to launch very soon. And let's hear from the expert herself directly about the constitution of the fund and more on the sector side. Welcome to the show, Shelly.
Thanks, Neeraj. Glad to be here.
So let's start with the Nifty Realty Index Fund, the Tata Nifty Realty Index Fund. Can you throw some light about the realty sector overall? What are the macro trends you are seeing currently in this sector? And are you seeing more growth in the residential side or the commercial side?
So the trends on the residential side, we are seeing emerging across inventory levels, across the demand side and on the supply front as well. On the inventory levels, we've seen that, the inventory levels have dropped tremendously from a peak of, say, 14 months to sell the entire stock in 2017 to about 15-16 months currently, which of course RERA has been a great assistance to pan that out because prior to the RERA coming in, there was a lot of money rotation which was happening and the projects were getting delayed.
Yeah.
And RERA got along a lot of transparency to protect the home buyers. Primarily by disclosing all the project details, by mandating an escrow account where minimum 70% of the monies which come in the escrow account needs to be deployed in the same project.
Yep.
So the project sales have been faster. So inventory levels, because of that, because of whatever has been launched in the last 2 years, the projects, almost those project sales have happened in the first year itself. So RERA has helped a lot in bringing down the inventory levels. On the demand side, post-COVID, what has happened is with the employees coming back or with companies moving away from the work from home format, the employees and people have come back and, the demand for houses near the workplaces, that has shot up like anything. That has caused rentals surging across the cities. In fact, I was reading that rentals in cities of IT-oriented cities of Pune and Bangalore, in fact, they have surged to the tune of by 15-16%.
Yeah.
In Mumbai and Chennai, it has been high single digit to about 8 to 10%. So the rentals have surged. And of course, supply what it is. It's limited to that effect. So with the demand rising and the supply being limited, the prices, of course, have gone up. So that's one trend, which we are seeing. And with the rental yields moving up, people are preferring to, have an outright purchase rather than go for rents. So obviously, people are moving for home buying. And supply side also, the trend that we see is there's a lot of consolidation which has happened in the top tier developers. So their market share of the listed developers has increased. So I think we are seeing trends across.
Let's talk about residential, segment within the sector. What are your views on the future outlook of this sector? Because a lot of people are now preferring to renting rather than, buying the properties, particularly the millennials. They want to be always very asset-light. So are you seeing this disrupting the entire sector negatively, or what are you seeing on the ground?
So, rental yields play an important role. I mean, the average pre-COVID of rental yields of about 3%. If you see the rental yields shooting up much beyond that to 3.5-4%, then, even younger generation would want to go and buy. Yes, they do have a preference for experiences over current spending.
Yeah.
And we have seen that in multiple segments. But rental yield levels, play a very important role. If they shot beyond 4%, then immediately the, instinct is to go for buying. And the supply side is also getting a lot more strengthened. With income levels rising, your affordability is going up. We've seen EMI to income ratio improving across all key cities in India. And alongside, you have interest rates which are expected to come down, tracking the global central banks as well. So with all this coming along, it makes a strong case for overall the real estate market, doing well.
You mentioned on the demand side that people are actually having there's a growth on the EMI to the income levels. So are you also seeing more growth on the people's preference towards luxury housing versus an affordable housing?
So, so I think before that, let me just throw some light on the segmentation that the way we look at it is houses less than 50 lakhs, houses between 50 lakhs to crore, and premium segment, which you highlighted, let's say more than 1 crore. So we are seeing that the mid-income, mid-sized houses or the mid-priced houses, which is between 50 lakhs to a crore, that demand is quite steady. However, we have seen, an increase in the demand for premium housing, which is more than 1 crore. In fact, the number put out by, one of the reports was that 5 years ago, the top 7 developers pie of the overall residential sales came from 60% came from the premium segment. And that number has now currently moved to about 74%. So, and people are preferring post-COVID demand for bigger houses. We are seeing a demand for bigger houses. There are consumer preferences also shifting there. With some more revival coming in the affordable segment, which obviously in the overall pie has moved down from about 35% to about 25%, and the luxury has actually moved up allocation in the overall pie. But with some more allocation coming in from, or some more revival coming in from the affordable segment, real estate overall segment will be doing phenomenally.
When you talk about the revival in the affordable segment, do you see that government's push for housing for all and other schemes are helping on the ground to make a boost for this segment?
Yes, surely, because finally real estate segment also has an impact on job creation and corporate capex, and then it comes back and helps the real estate sector. So overall, government's push, like in many other segments of manufacturing or infrastructure, even on real estate, the government policies and schemes would surely provide a push. And we're already seeing green shoots in the affordability improving, across the cities, and the EMI to income ratio improving quite well. If you compare 5 years ago and now, numbers across the cities of Mumbai, Bangalore, Pune, NCR, everywhere, Hyderabad.
And let's talk a little bit about the structure of the overall sector from a supply side. I mean, are you seeing a lot of organized players taking a higher share or the higher pie in the overall sector, or versus how are the unorganized players?
Yes, as I said, with RERA coming in, the market share gain of the listed developers and the large developers have improved. 5 years ago, I think they had about 13% of the market share, which has now improved or moved up to about 19 to 20% as we speak. So that has happened, and this sector is such that there are about some 70 stocks in the overall across large, mid, and small cap stocks on the real estate developer piece. Just zooming in on the real estate development piece, not the overall allied housing.
Yeah.
And this index consists of about 10 stocks. So these top 10 or these stocks themselves take away 85% of the market cap. So this is a segment which is, where there is a market cap concentration amongst a few players, and those are getting strengthening further. And with this index itself, some 85% of the market cap of the overall real estate developer segment is getting captured very well.
So you mentioned about the index having roughly around 85% being captured by, high concentration is there by some of the players. So would it make more sense to have an active, play in this segment or a passive, because this sector is very cyclical and depends on the economic performance of the overall country. So how do you see that?
Yes, you rightly put it. The sector is very cyclical. Agree to that. But when you look at market cap concentration, when you look at cycle similarity between the sub-segments in the sector, or you look at how is this sector driven, when you have just one or two drivers of the sector, and you have few players taking away a large part of the market cap, and the cycle similarity being very, very high, it might not make too much of a difference between the active and the passive funds. In fact, the discipline in the passive is good enough for the client to, capture this space very well. Just within this index, the top 5 to 6 stocks actually take about 70 to 75% of the overall market cap. So this is a sector which is now driven by very strong few listed players, and it's good to capture them wider passive index, the Nifty Realty Index.
Talking about the index a little more in detail about the risk side, how do you see the risk in this kind of a product, and how should a retail investor take exposure to these kind of funds in their portfolio, and what should be the horizon they should look at?
So, sector funds should be reviewed 3 to 5 years, unlike some of the core funds which can be, held for very, very long term. It's good to review sector funds intermittently. And the index methodology here is such that, all these stocks are laid down in the descending order of the free float market cap of those stocks. And there is a review and reconstitution which happens every 6 months. So to maintain the robustness of the index construction, and as I said, the discipline which it brings in, because it has picked up a part of the market, yes, and has laid out rules to construct an index on that. And because that market or that pocket of the market we are constructive on, going passive through these rules of index creation and reviewing them regularly, it provides a good way to capture the real estate market and that pocket of the market very well. In fact, in the last 5 years and 10 years, if you see, the reality index has outperformed Nifty by a huge margin, Nifty 50 by a huge margin.
So would it be safe to say that, like, for retail investors particularly, they should definitely review it every 3 to 5 years, but on those similar lines, they should not hold maybe say more than 20% of their overall portfolio in this sector-driven themes?
Yes, it's good to say that. And, rather than going and taking your own calls on a sector which, is of course now getting more regulated and being more transparent, but it's better to access this sector-wide pack of stocks through a passive index and a passive fund, an index fund. So I think that makes more sense.
Okay, so thanks a lot, Shelly, for sharing your valuable insights with us and helping our investors understand a little bit more about the Tata Nifty Realty Index Fund and the sector overall.
Thanks, Neeraj. Our pleasure. Totally our pleasure. Thank you.
So, ladies and gentlemen, that's Shelly Gang from Tata Asset Management for you. I hope you like our content. For more such interesting videos, subscribe and follow our channel.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.